Hello and welcome to our discussion on accounting. In this session we will try to understand accounting equations, and for that we will take some few examples. So let us first see what is an accounting equation. Accounting equation shows at a particular point of time the assets of the company will be equal to the sources of the company. So that means if a company is having some assets, there has to be corresponding sources. So assets at any point of time should definitely be accompanied by the corresponding sources. And these assets can be cash or any other assets like land, building, plant, machinery. And the sources are, at this juncture, we would like to confine myself to these two sources. The sources are equity or the sources are liabilities. And equity consists of the capital, money contributed by the shareholders, and the profit, which is money generated by the business. And the liabilities are the money contributed by the outsiders, and these outsiders may be bankers, suppliers, or other financial institutions, and sometimes the supplier of capital goods. So there are varieties of different types of liabilities which we see as we move along. Now let us take this example. A set of transactions are given here, and we'll try to convert these transactions into the accounting equation. As we said, accounting equation shows the sources at a particular point of time are equal to assets. And this equation is of the company, not of the individual shareholders. So started business with cash. That means the owner has given cash to the business, and business and the owner are two different entities. We know that one of the important concepts of accounting is that owner and the business are separate. So that is called business entity concept. The balance sheet of Infosys is the balance sheet of the company, not of the shareholder. Balance sheet of Wipro is a balance sheet of the company, not of the shareholder. So the business and the business entity are two different entities. So therefore, when the shareholders or the owners or the promoters, when they start the business, this 30,000 becomes the asset of the company, and the corresponding source of that is capital. Capital is the money contributed by the shareholder. So after the first transaction, the equation looks like this. The capital is equal to the cash. Or in other words, assets equal to the sources. Now the business or the company or that entity availed 10% loan, 120,000. So as a result, the cash increases. So cash becomes 150 because 30,000 was there and 120,000 you have received it. But there is no change in the capital because the money has not come from the shareholders, but money has come from the bankers or the loan giver, and we call that as a loan, and loan to the extent of 120,000. So the sources are once again equal to the assets, or assets are equal to the sources. Purchase goods for 75,000. You have cash 150,000 and purchase goods. So goods, let us give a name to that, called stock. And stock is now 75,000. Goods purchased 75,000. So 75,000, and it has been purchased for cash. So cash comes down to the extent of 75,000. No change in the capital, no change in the loan. The sources side is now once again equal to the asset side, we can see that the cash is converted to stock by taking a business decision of acquisition of stock. No change in the sources side, but change in the composition of assets took place, and the cash is converted to stock, and this stock entire stock is sold for 150,000 for cash. So once again cash increases by 150,000. Stock becomes zero, no change in capital, no change in the loan. So the balancing figure is a profit, and the profit is equal to 75,000. As a result, once again, the sources side is equal to the asset side. But how did we arrive at this profit? Profit can be determined in two ways. At this juncture, we'll say that profit is equal to either as a balancing figure. If it is a balancing figure, we say that profit is equal to, profit is equal to assets, which is cash here, minus the capital minus the loan. There has to be a source, and that source is a profit. Or profit can also be determined as a sales minus the corresponding cost. So 150,000 minus the cost of goods sold is 75,000. At this juncture, we have not recognized the interest. So this is the profit of the company without recognizing interest and other expenses which are not given here. So accounting equation is a process of converting these transactions into the sources and the corresponding assets, and the sources and assets is called accounting equation, and this accounting equation becomes the basis for preparing or converting the business decisions into financial statements.